I guess you saw a brief kind of profile of all the esteemed speakers, but I'd like to kind of enhance it a little bit. On the dais, we have Parag, who is the Managing Director of Inventors Capital. And Parag has one unique distinction that after his IIT and his IIM degree, he actually spent the longest period of time in the venture community, starting with ICICI Ventures in the late 1990s, and has seen the entire VC landscape emerge. Then we have Rajesh. Rajesh is the MD at Kalari Capital. Everyone knows about Kalari. They've done some really cool deals in the e-commerce space. And prior to that, he was actually focused on growth. So he's most qualified compared to all of us to talk about growth stage funding. And then we have Ravi. Ravi actually is also an IIT grad and spent some time in the consumer space before joining Venture East. He's also an ISB grad, Alan. And he's with Venture East Life Fund, so he probably will be able to shed some light on what happens when you kind of try to growth fund businesses in the healthcare domain, which could have a very, very significant offline component. So some of the things that I want to talk about, so since I'm the least qualified, I've actually done 3 companies. I've actually been in exec positions, I've been a professor, and only recently I'm a venture capitalist, so I'm going to turn it around. So this is a perfect role, probably Dipin knew what I should be doing. So that's why I'm probably kind of just going to be directing questions. So some of the things that one should look at is when you're funding a company for growth, is it an online business or an offline business? Because the metrics are going to be very, very different. And how do you gauge that? And when do you get ready for that? And you will find different kind of avenues for funding. Who should fund an offline business versus an online business? And what should be the right time to do it? Other factors are, what are you going to use the growth funding for? Is it for actually expanding your geographical spread, or is it expanding in the local market? So for example, if you're an online player, a good example is Taxi for Sure. I mean, there were 12 people who started off, as Raghu had mentioned earlier. 3 of them actually started to do well, and it was all about land grab, and they executed well, and because they executed well with appropriate capital efficiency, they got an opportunity to get acquired and basically merge with Ola. So that's one example. So if it is basically land grab, how do you go about doing that? If it is about geographical expansion, it's going to be very different. If it's a consumer play steady for growth, your growth capital needs are going to be very different, and the sources are going to be very different. If it is an enterprise play looking for growth, it's going to be very, very different. If it's a channel play, it's going to be very different. So the organization itself needs to morph, and you may be spending quite a bit to kind of enhance the organization also. So keeping all of this in mind, what I'm going to do is I'm going to actually direct a few questions. We're going to change the format. We're not going to actually kind of come and speak to you for 6 minutes or 8 minutes. We're just going to change the format, have a few questions, and then throw it open to the audience, because I feel interactivity is a better source of exchanging information. All right. So I shall start in this order, left to right, since Parag is here. So Parag, you've actually seen the VC landscape change quite a bit since late 1990s to now. One key indicator is the absurd valuations, which all of us talk about. And a few things that I learned in my recent kind of foray into being a VC is, I learned a lot of nice acronyms. One is DAO, MAO, the market is frothy, okay, all that. So what is your impression? And you went through a similar thing like Taxi for Sure with Redbus. So when did you think that they were ready to scale? What was the key pivotal point, and how did you go about actually helping them raise that growth funding?
Raghu was brilliant today, for example. But I think some of these businesses that are maybe possible today because of the technology element are what I call build and they will come businesses. A classic example being an Airtel. When you put up all these towers, the first telephone is so costly, but the millionth telephone is not. Similarly, in Raghu's business, for example, initially he'll have 5 taxis, 10 taxis in an area, and then he will have 100 taxis in an area. But you have to fund the losses still there. Redbus, on the other hand, is not a build and they will come business. It is as you make revenues as you go along. Being a conservative, small-sized fund, we have taken to Redbus kind of models than we have taken to Taxi for Sure. Maybe it's just necessity is the mother of invention. We are a small fund, we can't afford to cut out those kind of checks. We can't afford to put 15 million into the company, for example. And some of these models are just not possible. So very honestly, I mean, if I look back and see benefit of hindsight is always 2020. Those qualifiers apart. If we had not sold Redbus, we would have probably got 3 to 4x the price today. Okay, so that is kind of simple. But what, leaving that aside, for the scale companies, I think the valuations have gone up tremendously. Leaving that aside for a moment, I think what concerns me more than valuations is the amount of money that a company loses. At the end of the day, when you ride a tiger, when you're, and no pun intended, when you ride a tiger and the money source disappears suddenly, for whatever reason, Mr. Narendra Modi does something, for example. So if that disappears, then you're dependent on somebody. And that's the one that scares me. Valuations go crazy, markets go up and down. So I've seen enough of those. I don't think people will lose on valuations. People will lose heavily because if the money sources do it.
When the things started to explode, how did you actually kind of help your portfolio companies actually raise those large rounds? Because these are not small checks.
Yeah, I'm sure it's easy for us to sit back now and say that we were visionaries at that time, and we had this magic 8 ball, and we saw everything that's going to unfold in front of us. I think the answer to that is simple. We had no clue how the market is going to evolve. The only thing we bet at that time, and we continue to do that as a core philosophy at the fund, is bet on a great entrepreneur. And if you look at both those companies, maybe they're part of the 2 largest e-commerce companies in the country, Myntra being part of Flipkart and Snapdeal. We didn't invest in e-commerce businesses. In fact, Snapdeal was a coupon book company. It was not even an online company. We just bet on Kunal. He was just impressive. We knew that this gentleman, or this kid at the time actually, can sell ice to Eskimos. And he can sell us on a coupon book company. He can figure out a way to build a large company. He can convince the entire ecosystem in supporting him and whatever he does. That was a simple core philosophy upon which we operate. Myntra, they were doing small online t-shirts, customized t-shirts and gifts, etc. They were not a lifestyle company. They evolved into a lifestyle company. Again, Mukesh, the same thing. We just believed in him. He's a great person and great communicator, great leader, and we will figure out a way to evolve with him, and we'll support him. We'll help him through his journey. And you have a gut feeling about few people. I don't think you can have a gut feeling about a market evolving. Of course, later when the e-commerce trends started exploding. And we felt that India being a large country, of course, all of us sitting here and all the venture capitalists, you look at what has happened in the US, China, why should it happen in India? And there are some categories which are going to be large, humongous, and there are going to be some leaders. And when Snapdeal and Myntra started taking off and showed the leadership position, it was still wasn't really easy. I mean, 2011, 12. There was no funding for e-commerce companies. We knew we had winners on our hands. We believed that e-commerce was going to really evolve. We may not catch up to China, but we have the potential to get close to China. And if a $200 billion company in China can be created, a $50 to $100 billion company in India is possible. Right? So with that in mind, in fact, we bet big after we knew we had winners when the rest of the ecosystem was still trying to shy away from e-commerce. That was a bigger bet. We didn't know the first check was not an e-commerce bet, but the second, third, fourth checks were big e-commerce bets. And I'm not worried about valuations for companies like Flipkart and Snapdeal. I think India e-commerce is already a large enough market, but will be 20, 30-fold from where we are today. I think it will be a $200, $300 billion market eventually. And the winners, like most technology network models, are going to take the big piece of the pie and pretty much winner or 2 winners take it all model. And I'm not as concerned. Yes, the valuations are way ahead of where they should be, even for the large companies, but that's not a concern because they will make up ground by growing at a rapid pace because the ceiling is so high. The problem is for the entire, the rest of the ecosystem, when there are too many Me Too companies trying to go after the same pie, and in every niche, whether it's e-commerce or any other online product or service, trying to fight for the same pie, the consumer is the same, and the consumer's wallet is not growing 100-fold like the number of companies coming to the fold. So you're going out to the same consumer, you'll end up spending 10 times what the entire ecosystem should be spending for the customer acquisition cost. So I think that there needs to be some sanity. Not everyone can be a leader, and you need to pick your niche. You need to figure out the amount of customer acquisition costs. Are they reasonable? Are there sanity or not? Those things kind of concern me primarily because there is a winter coming. And I'm a believer. I mean, being a venture capitalist, saying that there is going to be a correction is little hard to digest even for my own team. They question my loyalties sometimes. But I've been through the late 90s burst, and I've been part of, personally lost a lot of wealth in the 2008 real estate correction, right? So I do worry about these things. And this time the stakes are high for India. We have a huge, long way to go, and you don't want a correction to kind of scuttle the pace at which we should be growing for the next 5 to 10 years. And I think there needs to be some sort of caution on the businesses we support, and for entrepreneurs as well, the kind of businesses they should be starting. Don't leave the revenue profitability models outside the window just because you see some businesses getting funded. Without those models in place, be a lot more cognizant about this.
So this is a nice segue into a follow-up question for you, Rajesh. So don't let the mic go yet. So one of the things is, I mean, you said valuations you're not that concerned about, but I think touching upon what Parag mentioned earlier, if the valuations go a little bit stir crazy, and you don't find people with deep pockets coming in. So one good example is what happened to SnapTiE, where I think it got delayed, right? And everyone's prepping themselves up for the next expansion. And at the backdrop, you're predicting a nuclear, I'm not saying that's a very, very strong word, but like you're thinking that there's going to be a correction. I think most of us also are in the same kind of situation, and we are actually trying to figure out how to shore up some of the companies which have actually grown quite a bit. For example, we have some companies in our portfolio who have actually kind of crossed the threshold. They're starting to do well nationally. Similarly, you have like a few which have started to kind of become the leaders. It's very critical that like they have cash in the bank when the opportunity presents itself. Even if there's a slowdown, these companies should still be prevailing. So is there sometimes a decent rationale to go back to the founders and say, hey, this is what may be happening, and how open are they once they've reached some level of success? Because sometimes founders can be reasonably adamant.
I mean, as venture capitalists, we go and preach to the larger ecosystem, including the entrepreneurs, that we bring a lot of value to the table, right? But if I truly think about, I think the real value we bring to the table are situations like this, where entrepreneurs are born optimists, and they should be. If they see negativity, then you cannot build a large business. You need to have the belief that whatever may, I will fix it. I'll move ahead, and there is nothing that can stop me. And that optimism is absolutely necessary, and no issues about our optimists. And we need optimists for building these risky businesses. But having said that, the true value as venture capitalists, what we can add is, how do you convince an entrepreneur who is not going to see those days of winter, right? And most of the entrepreneurs in India are first-time entrepreneurs. That's the worrisome thing. I mean, I think 10 years from now, we're going to see people like Raghu doing second, third ventures, and they know the ups and downs of the market. I think there's going to be a lot more understanding, more mature ecosystem. But today, most of our entrepreneurs are first-time entrepreneurs. They don't know what a bubble means, what can happen to an ecosystem, how everyone gets washed out, and whether it's your fault or not, it doesn't really matter when the bubble bursts, right? So it's our job to convince them that raise money well ahead of your needs, and don't worry about the dilution. The biggest worry about raising money when you don't need money is why should I dilute more, and why don't I wait for 6 months, 9 months when my company has better metrics and I can raise it at a higher valuation. That's the mentality most entrepreneurs have, and I spent significant amount of time recently, more time convincing all my entrepreneurs that don't worry about the right time, raise it now. And the good thing about, there is a good side to a downturn as well, right? And if you believe that you have a solid business and you can raise enough money and have enough money in the bank, it's actually a good thing. All the Me Too's will get washed out, and people with money and solid business plans will survive, and you'll spend so much less money, and you will burn less of your investor money, and you will be, you take for example Amazon. There were hundreds of Amazons at the late 90s. They raised the money at the right time, they went public at the right time, they had a huge amount of cash in the bank, everyone got washed out. If all those companies existed and were funded and the bubble did not burst, Amazon would be the company that it is today. They wouldn't have grown as fast as they did, and as dominant as they become. There would be multiple Amazons in the US, because the US is a large enough market. Everyone got washed out and Amazon survived. And so having cash in the bank can be a great boon, and a downturn can actually help you in the long run.
What are you seeing in the market, especially in terms of scale and the organization? Because if you look at healthcare, not all of it is tech-enabled. It's one of those industries which has actually been always slightly behind. And it is reasonably CapEx intensive if you're talking about healthcare. So how does one scale? What does the funding need? How do you go about doing things? And why should there be a greater focus on profitability with these kind of companies versus, say, a pure online services company?
So that's a great question, and we keep on deliberating on that given the current context. For our investors, they have put money in funds like Kalari or Helion, who are investing in e-commerce. So we have a common investor pool. There might be a few exceptions, and their expectations are exactly the same in terms of returns. We are in healthcare, not in e-commerce. So how do we create non-linearity in growth without having the land grab kind of philosophy of investing? So in our case, I'll just give an example, but it can vary from one healthcare company to the other, or one clean tech company to the other. If we are running a chain of clinics, the only way non-linearity can come is if the unit clinic breaks even in 6 months and pays for the next clinic. So one clinic pays for the next clinic in a year's time. That is the only way non-linearity can happen in our model. Otherwise, we'll see the same rate of growth which the economy is seeing, say nominal 15-16% growth rate if you take into account inflation. So our way of looking at opportunities is that whatever you are doing at a unit level should be paying for the next 2-3 units in a year's time or 18 months time. And that is the only way we can match the returns that e-commerce play can do, because eventually we'll have to do that. We compete for the same share of investor money for our funds. So that's one thing. The good thing about today versus say 7-8 years back is technology is enabling a lot of growth. We are driving businesses, we are driving consumers to consume healthcare services through the internet. TiE is an example. It is a home health services company which we have invested in, where technology plays a big role. How the patient records are managed and shared with the patient over the cloud and so on and so forth. So technology is coming in. That in fact is a very big interest area for funds like ours, where there is a place, interplay between what we do in say healthcare or clean tech and how technology plays a role.
Parag, your takeaway with this whole kind of basic brouhaha about IoT, Internet of Things, embedded solutions, more hardware components. I mean, everyone's looking for an end consumer solution, an end enterprise solution. How do you think entrepreneurs should scale that business? Because it's got enough of a capex component, enough of an opex component, enough of a hardware component, enough of manufacturing. So do you think things will change? I mean, how would you approach it?
For example, when I was doing my mechanical engineering many years back, the gyroscopes and the accelerometers were things that fit into an aeroplane. Now I have it in my pocket. So that's what. See, what most people focus on are what has happened to the processor inside, etc., etc. What most people forget is the sensors have become so much cheaper, and you are a hardware guy, much better understanding that than I. You're not a hardware guy, but you probably have a better understanding of hardware than I do. So I think these sensors have become so much cheaper that in itself provides a huge opportunity in this area. The wireless systems, backhaul, I mean, if it is GPRS or 3G, etc., it's so much easier. So the possibility today to measure almost anything, let's say in a telecom tower, and make that more efficient is possible. At the end of the day, it all boils down to execution, as Raghu said. Who comes out with the best solution, fits it best, it makes it defensible, etc., etc., puts a complete solution together. Because it's not only the hardware, it's up there in the cloud, in the solution, what results you predict, how you analyze the data and all of that. So it's the complete solution that will make the difference. I'm reasonably bullish on that space, very honest.
It's good to always take money before, and I've actually heard that as an entrepreneur ever since I was in the Valley. So very, very good advice. But do you think, actually, as we roll forward in the next year, 2 years, and with the backdrop of a possible nuclear winter setting in for a while, you'll see a lot more consolidations happening?
Yes, I mean, I do see a lot of consolidation happening, and I think the trend has already started. You see the larger companies, Flipkart and Snapdeal, they've started that trend, and I think it's a healthy trend. The big problem as investors and as entrepreneurs that we face in India is the exit mechanism. Raghu for Taxi for Sure, he found a decent exit mechanism. But most often, the two avenues, whether it is a IPO or M&A, both are actually bad avenues in India. First of all, the IPO market has been dry forever, and we still are not seeing any signs that it's going to improve. Second, as a culture, the domestic M&A is extremely weak in India. We believe that everything can be done in-house. There is no need for either outsourcing. For example, we are the outsourcing capital for the entire planet, but we don't like outsourcing our own stuff within India. We don't like buying any off-the-shelf software. We believe that you can build it in-house. There is nothing like I have a core skill that we focus on that. Let other people who know about software or services, let them come and help me out. That core belief is not there, and that kind of translates to M&A as well. So you believe that you can grow organically better. Maybe you will wait 6 months, 9 months, 12 months, but that's a better option. You're looking at, or the Indian entrepreneurs tend to look at the value that they are saving by doing organic growth and not buying somebody for inorganic growth. They don't value time, and there will be a time soon, hopefully soon, when people will start valuing time, and you need to get large fast for a variety of reasons, and in this, especially what we do, technology-driven world, time doesn't stop for you. For you to figure out organic ways of growing, sometimes inorganic ways are the best ways to grow. And the new age entrepreneurs like Flipkart, Snapdeal, and others, like Ola, are a lot more keen in pursuing those strategies, and which is a very healthy sign, because there needs to be a lot of churn in the system. You need to take out competition. Taxi for Sure, I'm sure they add great value to Ola, but they're also trying to see, let's make it a 2-man race. The 3-man race is too much distraction. right? So you need to take out competition. There needs to be money in the system. People like Raghu should see some money come back to them, and they need to go and reinvest into the ecosystem. The M&A churn, which creates a great ecosystem in the US, and IPOs can be the only way to get exits and make that money move. And money moving is extremely important in an economy, and India needs to get there. The only M&A we seem to be hoping for is outside companies trying to coming and buying Indian companies. That's what's been happening. But the new age entrepreneurs like Ola's, etc., are starting this internal trend, and consolidation is happening. It has to. I think we've not even scratched the surface where we should be. I think it needs to accelerate. And when we have larger market cap companies like Flipkart and Snapdeals, they have the currency, they have the paper currency and cash currency, and they need to be a lot more aggressive and make this as part of the understanding and culture rather than just one-off things.
So slightly different investors or investment strategy required as things start to scale. So did you actually find it to be more challenging to find deeper pockets as things started to expand?
The only challenge was that when we invest, we come in very early. So for us, revenue market share is the metric that we look at. The core competence of providing the clinical service is important for us. And when we go from Series A to Series B, we have not had a deal where it is purely revenue metrics. It is EBITDA metrics. Even if it is a forward looking metric, it is always tied to EBITDA or profitability. So that's the transition that we need to prepare for. And we always advise the companies when they are looking to raise the Series B round, start looking at these metrics more than revenue market share in their respective sectors, so that when they start negotiating, they have a healthy profitability profile, and they can raise money much faster and at good terms.
I'm Nishant, and maybe a question can be a generic, anyone can pick it up. So, like last this session, we have been talking quite about if I understand, B2C space, like Flipkart, Snapdeals of the world, and you did mention about enterprise businesses, but my question is that I'd like to hear from say Parag or other guys, that how do they look differently, if at all, to enterprise product solutions, and when they are about to kind of invest in, or when they evaluate to invest, like more in context with, we know there are companies like, especially Capillary Technologies, Manthans of the world, right? So I find that that's an area where we work in that area, right? So I'd like to know how they look at this space, especially enterprise, and when they go out for evaluation.
Sure.
So if you look at our first fund versus our second fund, our first fund was dominated by B2C kind of companies. Today B2C is very, very sexy, as you can see. You read the newspapers, you know that obviously. But our second fund, the pie chart looks really biased towards B2B, as it happens. We didn't intentionally create it that way. I think there is an opportunity today. I think Sharad Sharma in particular says this beautifully. He says, this time around, there is a level playing field for Indian entrepreneurs, simply because earlier distribution selling was so very difficult. Oracle had to have a sales force on the ground, door to door, etc., etc. Today, if it is a small enough product, you can put it up. Hotel Logics, just to pick a name, can put it up, or a Dhruva can put it up. Somebody can test it out for 30 days, and then somebody can buy. So SaaS changes the equation in that sense, and it is enterprise software. At the end of the day, you would have noticed there's so much difference between the B2C discussions we are having and let's say something like venture is investing in. There's almost a divide. The same divide exists between B2B and B2C, unfortunately, from the investor's perspective. But let me tell you, there are some of us. Axel has done quite a few B2B. We have done quite a few. So feel free to talk to any of us. We don't have any flavor of the day is not for us. So please do speak with us.
I just want to add, I mean, I think the whole thing about us being able to figure out if it's a good enterprise tech deal to invest in or not is the very point that like Parag was mentioning. It has to be lightweight. It has to have the notion of consumerization of the enterprise, which means easy to use, download, less support, less overheads in terms of SG&A or whatever, right? And it has to have a subscription model, which is tending to grow, and it needs to be global. So very good example is Freshdesk, which was a good competitor to Zendesk or Zoho, or like ChargeBee, or he talked about Thruva. There are lots of emerging plays, and I think the market is now an even playing field. Yet another opportunity is if you look at like the entire stack, there's hardly any good tools at the IT operations level. Everything is heavyweight. So lots of players there. I mean, so this is happening. It's not going to be having the same momentum like B2C play because that's basically something which is immediate, you can see it. But definitely there are good players, and we'd be happy to talk to you just like, and we work with Parag also. So.
For building machine learning and intelligent algorithms which provide solutions to different problems. Not only SaaS is an enterprise software which costs almost from ranging from 8 lakhs to 24 lakhs, depends on the domain. But right now our ISB is focusing on more R. It also gives a lot of algorithms, it also has a lot of solutions for different problems which ISB entrepreneurs are trying to solve using R. So venture capitalists, they also look at R for solutions built based on R also we consider for the next round of venture capitalism.
I'll jump into that. See, one of the things with actually going with a technology horizontal play which is embedded is the fact that the kind of monetization does not come very easily. Now say, if I'm the CTO of Snapdeal, I do know the gentleman really well, they will try to actually build these algorithms in-house. And that's partly because of the NIH syndrome which Rajesh was mentioning earlier. But if you have a distinction, like for example, there are a couple of companies in the US who have actually taken all these algorithms, standard algorithms, made modifications, and they're available through REST APIs for other people to use on an API call basis. So you can monetize it, but I feel it's a longer struggle because your technology, your horizontal, you're embedded. You're better off actually kind of solving a complete business use case as opposed to just doing algorithms. This is just my opinion. Thank you very much. I'd like to thank the esteemed gentleman on the dais for